our YouTube channel. You are going to learn cost accounting with Jeewa. In this video, I am planning to discuss with you about break-even analysis. It is a very important decision in the business. How much do I need to sell to break even? So what does that mean, to break even? So it is the point where I am going to cover all my cost incurred, right? In simple terms, it is the point where I am going to start to earn profits. Let's say whatever the business activity, if it is not a profit motive, a non-profit motive organization, or if it is not a charity organization, what's our main intention? To earn profit as much as possible. So it is very important for us to know at which point I am going to start to earn my profits. So at the break-even point, you are going to cover all of your costs which you have incurred so far, and beyond that limit, whatever the number of units you are going to sell, then you can have profits. So simple terms, at the break-even point, you don't have profits, you don't have losses, right? Okay, now tell me, how do you calculate profit or loss? Simply, it is income minus expenses. I told you, at break-even point, right, the point where you are going to cover your expenses, at break-even point, you don't have any profits, right? So you don't have any losses, right? That means you don't have any profits or any loss. That means your profit value should be equal to 0 and your loss, it should be equal to 0. Now what I am going to do, I am going to substitute this value to this equation. Profit or loss, it is 0 at the break-even point, and income minus expenses. Now what I am going to do, I bring this minus expenses to this side. Now what happened? Expenses equal to income, but I write it in a familiar way. What is that? Income equal to expenses, right? Income equal to expenses at the break-even point. Why? Because at the break-even point, I don't have any profit or loss. It's obvious if you don't have any profit or loss. If you calculate your profit, income minus expenses, right? So at the break-even point where you don't have any profit or loss, your income should be exactly equal to your expenses, right? Can you remember when we were learning in small grades, or else when we were getting ready for O-level exams, when we were learning science concepts, most of the time we had assumptions, right? So we assumed all the items, weight of all the items equal. This is the theory. If the pressure of the whole pressure in each and every point is equal, this is the theory. Likewise, we learn lot of theories and concepts with many assumptions. For the break-even analysis also, you are going to have few assumptions. Now, I told you so far what is the break-even point. It is the point where you don't have any profits or loss, right? How do you calculate the profit or loss in the company? It is the difference between income and expenses. So at the break-even point, if you don't have any profit or any losses, that means this side should be equal to 0, and 0 equals to income minus expenses. Then that minus expense I brought to this side. Now income equal to expenses at the break-even point. That means at the point where you don't have any profit or loss. Now I told you, when I am talking about the concept, we do have assumptions. So now the first assumption will come to the picture. What is that? Can you remember in my previous videos, I told you in the business we do have 3 types of expenses, 3 types of cost: variable cost, semi-variable cost, and fixed cost. But for the break-even analysis, right, to discuss this theory, first assumption will be, I assume in my business, I do have only two types of expenses, two types of cost, that is variable cost and fixed cost. That means you are going to ignore semi-variable cost. But in the practical world, we do have three types of expenses for the theory. So theoretical purpose, we ignore semi-variable cost. So that is the first assumption. So I'm going to write them in black color. We assume we have only two types of cost. So that's only an assumption, two types of cost. Right. So before erasing the board, you may go through it again. We are going to talk about break-even point. What is the break-even point? The point where we are going to cover all our expenses which we have incurred so far. That means at that point we don't have any profit or loss. How we are going to calculate profit or loss? The difference between income and expenses. And if you don't have any profit or loss, that side should be equal to 0. Then ultimately I arrived a formula, income equal to expenses. Before going to the further analysis discussion, I brought an assumption that, what is that? I told you, even though in the practical world we do have three types of costing, or three types of cost, as variable, fixed and semi-variable. In this analysis, we are going to have only two types of expenses, right? Then look at this. Now what I am going to do, how can I calculate my income? The same example I would like to bring you the small scale garment manufacturing business. So my small scale garment manufacturing business, my income will be number of units I sold times selling price per unit. That's my income, right? What's the selling price of a shirt and how many shirts I sold? That is my income. Altogether, it tells me the income, number of units sold and selling price per unit. Then this should be equal to expenses, and I told you I am going to have two costs in this analysis, that is variable cost and fixed cost. Okay. Can you remember? I told you, how can I calculate the total variable cost? It is variable VC instead of variable cost. Hereafter I am going to use VC, variable cost per unit times number of units produced, right? Okay. Number of units produced. Here number of units sold time number of selling price per unit, right? Now the second assumption will come to the picture. My second assumption will be, I don't have any stocks. That means whatever the number of units I produce, I sell it. Whatever the number of units I produce, I sell it. So the number of units I produce exactly equal to the number of units I sold. That means I don't have any stock. So the second assumption for my analysis will be, we don't have stocks. We don't have stocks. So if we don't have stocks, what happened? Right? If we don't have stocks, what does that mean? Number of units you produce should be equal to number of units you sold, right? I name it as X, right? For my calculation purpose, I name it as X, right? Now look at the way I am writing. Number of units sold, what's the value I gave? X times selling price per unit. So this is the short term. I'm going to use selling price per unit SP. And number of units I produce, again it is X times Variable cost per unit, I am going to use VC plus fixed cost. Okay. At the break-even point, all my incomes are equal to expenses, right? And I assume I have only two types of expenses, that is variable cost and fixed cost. How I am going to calculate my income? If I am engaging in manufacturing business, number of units I sold times selling price per unit. And how can I calculate my variable cost? Number of units I produce times variable cost per unit, because you know variable cost is something, it varies with the number of units we sell, right? Plus fixed cost. Okay. Then the second assumption, we don't have stocks. That means the number of units we produce should be exactly equal to number of units we sold. I name it as X, right? Here X times selling price equal to X times VC plus fixed cost. Now what I'm going to do, I'm going to bring this bracket to this side, because I can see in these two brackets I have a common value, that is X, right? Okay. Now look at this. X times selling price minus X times variable cost equal to fixed cost. Okay, now I take the common factor out, and what happened? Selling price per unit minus variable cost per unit equal to fixed cost. In management accounting, we have a nice term. Always we are going to use that term hereafter, right? That is contribution per unit. So in cost accounting, we don't talk about profits most of the time, right? We are talking about the popular name is contribution. How can you calculate the contribution per unit? It is the difference between selling price per unit and variable cost per unit. So this term is contribution per unit. Now you can understand what I did so far. So then X is equal to what? Fixed cost divided by contribution per unit. Now, if you have learned this break-even analysis earlier, you have studied so many formulas. I didn't want to give those formulas, because if so, what happened? Again, this will be a normal classroom where you learn the topic break-even analysis and formulas. But I wanted to give you the concept, because whatever the question you may have, whatever the practical scenario you come across in your day-to-day life, you want to know the basic concept behind this break-even analysis, right? That's what, without giving this formula straight away, I explain this much to give the basic concepts. Okay, tell me, what is this? X, number of units produced or number of units sold at break-even point. What is break-even point? The point where we don't have profits or loss, right? Now tell me, X, or the number of units we produce, or else the number of units we sold to cover all our expenses, or else to achieve the point where we don't have any profits or loss, or else technically to achieve the break-even point. How can we calculate it? We divide our fixed cost by contribution per unit. Then you can write break-even point in units, right? In units is equal to fixed cost divided by contribution per unit. So this is your first formula you should know in the break-even analysis, right? So another term we use for the break-even analysis, in some textbook you can see cost, volume, profit analysis. At the end of the lesson, I will tell you why we do have a separate name for that, especially when it comes to the graphs, I will tell you. So break-even analysis or cost, volume, profit analysis, the first formula will be, how do you calculate the break-even point in units? Fixed cost divided by contribution per unit. Now without studying, or else with so far what you did, you want to by heart everything and you want to study like nothing. Now you don't want to do that, because you know what is the break-even point, and that is the point where how much we need to sell to cover all our costs. That means at that point we don't have any profit or loss. What is that point? The number of units we produce. How can I calculate fixed cost divided by contribution per unit? Now, I told you, when you come up to this level, you don't have any profits, right? You are trying to cover your cost, right? You are going to recover your cost which you have incurred so far. Let's say for an example, my break-even point in my business, it is 500 units and I am planning to produce 1500 units, right? After 500 units, 501, 502, so up to 1500, whatever the number of units I am producing, I can earn profits. Now I am very happy, because whatever the business type, my main intention was to earn profits, right? After producing 500 units, after selling 500 units, now I know thereafter I can earn profits. That means I'll be safeguarded by whatever the number of units I produce beyond this unit. So we tell this term special name margin of safety, right? Margin of safety. So the margin which you will be safeguarded by this margin. How do you calculate it? Expected sales value, expected sales units, right? Minus break-even point in units. So this is the second formula you have in the break-even analysis. How do you calculate the margin of safety? It is the difference between expected sales units and the break-even point in units. So why we name it as margin of safety? Because you will be safeguarded by this difference, because up to break-even point in units, you don't have any chance to earn profits. Somehow you want to achieve this target to cover or to recover all of your expenses which you have incurred so far. Thereafter, now you are okay, you are happy, thereafter you can earn profits. So this is the margin which helps you to have a safety area, or else this is the margin which you can earn profits, right? So then I told you, whatever the business you want to learn about the profit, right? So how can you find the profit? Let's say the monthly profit. How can you find the monthly profit? Now you know which region or which margin gives you the profit. That is the margin of safety. Up to break-even point, you know you don't have any profit. But after that, whatever the number of units are expected to sell, the difference between expected sales unit and the break-even point in units, which we call the margin of safety, that number of units supports you, to earn monthly profit. Then what I am going to do, margin of safety units multiplied by contribution per unit. Why I had to do like that, contribution per unit? Because this margin only gives me the profit, right? This is the number of units. Then how can I find the profit value? I want to multiply it by contribution per unit. Why we considered the contribution per unit? Because contribution is selling price minus variable cost in management accounting or cost accounting, we don't focus fixed cost part which we have to incur somehow. It is something fixed in the business, right? So we consider contribution as the important tool to calculate the profit, right? Okay, so the monthly profit, this is the third formula you want to know in the break-even analysis. Monthly profit, how can you calculate? Margin of safety unit, you calculate it by contribution per unit. Now, I want to introduce another new term in cost accounting, that is CS ratio, right? So we write like, of knowing the CS ratio is, what is CS ratio? I repeat, contribution divided by contribution per unit divided by selling price per unit, and if you need the percentage, we multiply it by 100. Let's say for an example, my selling price is 100, right? And my variable cost is 40, and my contribution is, then what happened? Contribution, how do you find the contribution? The difference between selling price and the variable cost, it is the 60, right? If my variable cost is 60, sorry, contribution is 60 and my selling price is 100, what is my CS ratio? It is 60%, right? If you don't know anything, these figures, but you know the CS ratio of your business is 60%, what does that mean? If you sell at 100, right, and your selling price is 100, the contribution is 60, that means your variable cost is 40. Why it is important for me? Let's say I want to increase my contribution as much as possible. For that, what should I do? I want to either increase the selling price or else I want to decrease the variable cost, right? How can I increase my selling price and what are the repercussions I can have in my business when I increase my selling price? Let's say, so earlier my selling price was 120, right? So now I am going to introduce my new selling price as 150, right? I increase. Then what happened? How about my competitors' selling price? So let's say it is 125 or else 115, then 120, then what happened? My customers will go to my competitor. So there can be bad repercussions because my customers are not happy about my new price. Now again I want to, so that it doesn't work. So then I want to increase my contribution. For that now I want to reduce the variable cost. Can you remember, in variable cost basically we do have material and labor cost. Now to reduce the variable cost, now what I am going to do, I am going to decrease the material cost. For that most probably I have to select the low quality material which will affect to my product quality. That means it affects to my customer satisfaction. Again it doesn't work. So we want to do this. Yes, we need to have more contribution, but when we are doing it, we want to do it mindfully without affecting to our customers and our product quality and our sales volume. We want to do that. For that, in the business, we need to have an idea about our CS ratio. But in the break-even analysis, why we need to learn about CS ratio? To calculate the break-even point in value. How do you calculate break-even point in value? You know how to calculate break-even point in unit. It is fixed cost divided by contribution per unit. Now break-even point in value, it is fixed cost divided by CS ratio. Now you may think, so far when I am talking about a division, I use this sign, and for this I use this division mark. Why? Because fixed cost divided by contribution per unit. Can you remember your O-level math concepts? So fixed cost, here I want to convert this into a multiplication. When I am converting, what happened? I want to get the reciprocal, right? Then selling price over contribution per unit. Now tell me, what is this? Fixed cost divided by contribution per unit. What is that? It is the break-even point in units. So in simple terms, break-even point in value is break-even point in units multiplied by selling price per unit. Now can you understand? No need to buy heart anything, right? So break-even point in unit, how do you find? Fixed cost divided by contribution per unit. How do you find the margin of safety? So the region which will be so or else you will be safeguarded by this region. How do you find the expected sales volume or the expected sales unit minus break-even point in unit? And that margin will give you the profit. Then how can you calculate your monthly profit? It is the break-even, so margin of safety in units multiplied by contribution per unit. Then I brought a new term, CS ratio. How do you find the CS ratio? It is the contribution per unit divided by selling price per unit. If you want to get the percentage, you want to multiply it by 100. Then I introduce another formula, that is break-even point in value. One method you can find break-even point in value is fixed cost divided by CS ratio, or else you can find break-even point in value. How? Break-even point in units multiplied by selling price per unit. Okay, so depending on the information available in your question, you can decide which formula I am going to use. Either this fixed cost divided by CS ratio or break-even point in unit multiplied by selling price per unit, you can decide. Right. Now, so far we discussed about the break-even point and related formula. Now, let's say we have arranged everything. So, now I am going to start my business. Tomorrow will be the first day. All of a sudden, I got a phone call from the head office and he said to me, yes, we arranged you everything, we arranged the premises, we did the marketing part and we supplied the required labor force and everything we did for you. And as the unit manager in that particular branch, so we are expecting 50,000 profits from you during the month of June. Let's say tomorrow it will be 1st of June and it will be the first day. Now all of a sudden I got a call and they are expecting 50,000 worth of profit. So as the unit manager, now what I want to do? Somehow I want to sell the number of units to achieve the break-even point. Otherwise no survival, right? At least I want to cover the cost which I have incurred, or else the head office people have incurred to arrange this business for me, or else to arrange this branch, let's say. So then, meantime, I want to satisfy the head office requirement. Meantime, I want to achieve that 50,000 profit targets too. Now, I have an idea. Before I start my business tomorrow, I have an idea how many units I want to produce and sell to achieve the break-even point as well as that head office profit target, right? So for that, how can I have the formula? It's like this. Number of units, right? Number of units need to sell to achieve a certain profit, right? A certain profit. Can you remember when we were talking about break-even point in unit, it was fixed cost divided by contribution per unit. Now, apart from the fixed cost, now, right? So, apart from the fixed cost, now you want to think about that certain profit or the required profit. So, how can you calculate fixed cost plus required profit, right? Required profit divided by contribution per unit, right? Contribution per unit. That's the final formula we have in the break-even analysis. Now what I'm going to do, I'm going to summarize all the formulas we learn in the break-even analysis before winding up this lesson, right? Okay. Look at this. What is break-even point? It is the point where we don't have profits or loss. That means our profit will be 0, loss will be 0, right? So, how do you calculate the break-even profit or loss? It is the difference between income and expenses, right? So, when your profit is 0, loss is 0, that means at that point, your income exactly should be equal to your expenses, right? So then, how can I calculate my income if I am engaging in manufacturing business? Number of units I sold into selling price per unit. And I told you I have an assumption. The first assumption for my break-even analysis, it is I assume I do have only two types of expenses, that is variable cost and semi-variable cost. Based on that assumption, I wrote the first equation, number of units I sold into selling price per unit, that is my income. The whole portion should be equal to variable cost plus fixed cost. How can I calculate my variable cost? It is variable cost per unit times number of units I produce. Then the second assumption will be I don't have any stocks. How can I have my business without stocks? That means whatever the number of units I produce, I want to sell it, right? So then the second assumption will be I don't have stock. Then number of units produced, number of units sold will be equal to X. I took that X letter for my easy reference. Then X is the number of units produced or the number of units sold at break-even point. That's the point where we don't have any profit or loss. So how I got that? Selling price minus variable cost, the special name I gave you, that is the contribution, and break-even point in unit, it is units in fixed cost divided by contribution per unit. And how do you calculate the margin of safety? It is the expected sales minus break-even point in units. And how do you calculate the monthly profit? It is the margin of safety in units multiplied by contribution per unit. What is CS ratio? It is the ratio between contribution per unit and selling price per unit. And how do you calculate the break-even point in value? One formula will be fixed cost divided by CS ratio. The second formula will be break-even point in units multiplied by selling price per unit. Then the next formula we discuss, if you want to achieve a certain profit value, let's say to satisfy the head office requirement, right? So how do you calculate that? Fixed cost plus required profit, everything will be divided by contribution per unit, right? So this is the introduction about break-even analysis, and this is not the end of the break-even analysis. Because we want to do at least one question from this area, and we want to talk about the different types of graph we do have in the break-even analysis, and we want to talk about the pros and cons and limitations of break-even analysis. And at the end of the lesson, I want to tell you why we do have a separate name for this break-even analysis. It is the cost volume profit analysis, and I would like to remind you, so this is the fourth video under the topic cost accounting principle. Even though this is the first video for the break-even analysis, this is the fourth video for the cost accounting principle. And if you are a student who are getting ready for your A-level, either National A-level or the Cambridge A-level, and if you are reading for your degree or as masters, if not, if you are a student let's say getting ready for CIMA, CMA chartered, or else you are getting ready for banking exams. Now, whatever the exam category you are coming under, now you can understand this topic is a very popular one. So to get the maximum marks for this question, cost accounting and break-even analysis, join with me to follow all the other three videos. The second video will be a question discussion, and third video will be the graphs, different types of graphs. And if time permits, in the same video I am going to talk about pros and cons and limitations of break-even analysis. If the time doesn't allow me to do that, there will be a fourth video, right? So that's the summary of break-even analysis. To be a master of cost accounting, join with me and join with Jeewa, and don't forget to subscribe my channel Math with Jeewa. You may have lot of things to learn with this YouTube channel. Okay, see you, and we'll come back to you with a question related to break-even analysis. Okay, see you.